Welcome to the Wealth Wisdom, where knowledge becomes power and power builds your future.
Let's talk about underdogs, not the flashy blue chips everyone talks about, but the small scrappy companies quietly building real value, often where no one's looking. Because here's the thing, every big player today once started small. Apple was once a garage project. Amazon was a bookshop. Netflix a DVD mailer. So, when people dismiss penny stocks, sometimes they're missing the early chapters of stories that could one day dominate entire industries. Now, I'm not talking about speculation or hype. That's not what we do here. I'm talking about real businesses and industries that are growing fast, solving actual problems, and showing meaningful progress through their financials and operations. So, here's the question. How do you spot those small companies that are actually doing something right? How do you separate potential from pure noise? That's exactly what we're unpacking today. These two companies are operating in two of the most dynamic industries in tech right now. One focused on the smart infrastructure and AI-driven IoT revolution, and another powering the next evolution of data platforms and digital marketplaces. We're talking about sectors where innovation never sleeps, industries that could redefine how homes, businesses, and consumers interact with technology. Now, here's what makes this kind of analysis so fascinating. When you look at these smaller cap stocks, the ones trading at just a few dollars per share, it's not about where they are today. It's about whether their business models, financial trends, and execution show they can carve out a niche in their space. We'll break down the numbers, the stories, the moves that matter in plain English. Disclaimer: this video is informational and educational purposes only. No jargon, no hype. Just clear commentary that helps you understand what's going on beneath the headlines. By the end of this video, you'll have a full picture of two penny stocks making quiet but meaningful progress in their industries and what their latest numbers are really saying about where they're heading next. Before we dive in, please take a second to hit the like button, share it with your friends, and also subscribe. Please help this video to get at least 500 likes. It really helps to support the channel and keeps us bringing you the latest market insight. Thank you. First company is Tuya Inc., ticker symbol Tuya. You might have used devices connected through Tuya's platform and not even realized it. But here's the question. With AI, IoT, and smart solutions booming, can Tuya continue to ride this wave and deliver strong growth for investors? We are analyzing every revenue stream, margin, and cash metric, breaking it down so it's fun, easy to understand, and most importantly, engaging. First, let's talk revenue. In Q2 2025, Tuya reported total revenue of $80.1 million, up roughly 9.3% year-over-year from $73.3 million in Q2 2024. Not bad, right? But here's where it gets interesting. The growth is not just in one area. Platform as a service, or POS revenue came in at $58.1 million, up 7%. So the backbone of Tuya's business is still growing steadily. POS is where Tuya enables device manufacturers to connect products to the internet, essentially. It's the engine behind millions of smart devices. A 7% growth might sound modest, but considering the scale, it's solid and sustainable. Next up, software as a service SaaS and other revenue jumped to 11.1 million, up a hefty 15.6% year over year. This is the higher margin segment. Basically, subscriptions and cloud services. Growth here means more recurring revenue, which is fantastic for stability. Finally, Smart Solution revenue hit $10.9 million, up 16.7%. This segment is all about innovative IoT solutions. Think smart energy management, security, and automation. Fastest growing revenue stream. You got it. So overall, Tuya isn't just growing, it's diversifying its revenue streams. And if you're thinking, why does this matter? Diversified revenue can help a company weather economic storms better than one-trick ponies. Now, here's something to ponder. With AI and smart devices becoming more mainstream, can Tuya continue this growth trajectory? The trend seems promising, but let's see how the numbers support it. Revenue is one thing, but profitability tells the real story. Tuya's overall gross margin was 48.4%, slightly up 0.4 percentage points from last year. POS margins rose to 48.7%, up 1.1 percentage point year over year. Higher margins mean Tuya keeps more money from each dollar of revenue, essentially more fuel to reinvest in growth. Now, operating margin. Here's the jaw-dropper. Tuya's operating margin is 1.4%, up a massive 15.5 points from -14.1% last year. That's a huge turnaround. And the non-GAAP operating margin was 10.7%, slightly higher than 10% last year. This indicates that even after adjusting for one-time expenses, the company is running more efficiently, and net margin up to 15.7% from just 4.3%. That's nearly quadruple. Non-GAAP net margin slightly dipped at 25.1% from 28.4%. But that's still impressive. Margins like this, would you consider them healthy for a tech company in the IoT space? Personally, I think it's a strong signal that Tuya is not just growing revenue, but doing it profitably. Moving on to net profits, which really grab headlines. Tuya posted $12.6 million in net profit, up an astounding 30% year over year from $3.1 million. That's not a typo triple-digit growth. Non-GAAP net profits were $20.1 million, slightly down from $20.8 million last year, but still very strong. Let's take a look at cash generation. Net cash from operating activities reached $18.2 million, up 53.8% year over year. And Tuya ended the quarter with over $1 billion in cash and short-term investments. This is down slightly from $1.16 billion due to dividend payments, but still massive. Strong liquidity like this gives Tuya flexibility to invest in technology, acquisitions, or other growth opportunities. Let's step back. Why is Tuya relevant today? Tuya has been making waves by partnering with global brands to expand IoT integration. From smart homes to industrial IoT, Tuya's platform is becoming the backbone of connected devices worldwide. And with the AI revolution, the demand for smart solutions is only accelerating. Tuya is also tapping into emerging markets where IoT adoption is in early stages. That means new customers, new devices, and new revenue opportunities. Another trend: AI-powered smart solutions. Imagine devices learning your routines, optimizing energy, or boosting security automatically. Tuya's tech is perfectly positioned to ride this wave, and investors are noticing. The stock has been showing increasing trading volumes, reflecting growing interest. Of course, no company is without challenges. Tuya operates in a competitive space with giants like Google, Amazon, and niche players. Regulatory hurdles, especially data privacy laws, could affect operations, while profits are up. Non-GAAP profits dipped slightly, showing some rising costs, but overall, revenue growth, improving margins, and strong cash position suggest Tuya is executing well. Now, the next stock is WM Technology, ticker MAPS. WM Technology provides a B2B and B2C technology platform software tools for businesses to manage online ordering, compliance, and marketing. Think of them as the digital backbone helping shops run efficiently, advertise within regulations, and connect with consumers. In 2025, the company has been emphasizing software innovation and compliance automation. They've expanded advertising and data analytics products, helping businesses track consumer behavior. Another major talking point: profitability turnaround. Analysts highlight consistent positive EBITDA and net income as proof the business model is working. Revenue for Q2 2025 came in at $44.8 million, slightly down from $45.9 million last year, about a 2% decline. But in a heavily regulated market, flat revenue signals resilience. Net income jumped to $2.2 million from $1.2 million, an 83% increase. Even with lower revenue, cost discipline is the key. WM Technology has been cutting unnecessary expenses, streamlining operations, and improving efficiency. Adjusted EBITDA was $11.67 million, up from $10.1 million, a 16% increase. So the core business is becoming more efficient and profitable. Client count grew to 5,241 monthly paying clients, up 4% from last year. However, revenue per client dipped slightly to $1,850 versus $3,033, suggesting expansion towards smaller businesses. When you combine the metrics: slight revenue dip, higher profit, improved EBITDA, you see a company stabilizing. WM Technology is moving from early growth to a mature, efficiency-driven platform. Risks include regulatory changes, evolving client budgets, and competition. But overall, the numbers show profitability, momentum, cost control, and stable operations. MAPS is delivering steady performance. Revenue slightly down, profits up, EBITDA improving, clients growing, cash flow stable. In the world of penny stocks, stability and discipline often matter more than hype. Improving financials, stronger margins, and growing customer bases can signal a business turning a corner before the market notices. The market rewards curiosity. Keep learning, stay alert, and never underestimate the power of small beginnings. Thanks for watching, and I'll see you in the next one. Bye.